Welcome to the OPEX Effect, a joint podcast from Excess Returns and SPOTGAMMA, where we take a deep dive into the world of options and the flows they generate in the markets. Join Brent Kachuba and Jack Forehand every month on Options Expiration Week as they look at the major developments in the options world and how they impact all of our portfolios.
No information on this podcast should be construed as investment advice. Securities discussed in the podcast may be holdings of clients of Validity Capital.
Brent, welcome back.
Thanks so much. Glad to be here. First OPEX of 2024.
Yeah, I was thinking, given what's going on in the Northeast here, that maybe we do our first OPEX effect live from the ski lodge. I don't know if we could have pulled off the logistics, but it would have been worth a shot.
That's true. I would have supported that. So next time we'll do that. Snow day OPEX.
Yeah, exactly. So we got a lot to talk about today. We just got through a December expiration, which was a big expiration in the S&P 500. We've got a big one coming up in January, which is, maybe a little bit different than what the December one was. So we got a lot to cover. So, but before we do that, I think the first thing we always like to do here for anybody who hasn't looked at our previous episodes is to sort of talk about the OPEX cycle in general and how it works and why it's important. So can you do that before we get into what's going on with January?
Yeah, absolutely. So to your point, we like to start off with just a couple of ideas as to why options expirations may matter, how they can impact the markets. We're going to cover a lot of the details a little bit later in this presentation, but in general, as we have record options volumes on a daily basis here now in the not only in the S&P 500, but across equities in general, we think options flows are becoming more impactful to the underlying stocks. And the way that we look at this and the reason that we focus on options expiration is because we believe it's this cycle. And so what happens is we have options expiration, which is coming up here on Friday with the January regular monthly expiration. And as those options expire, any hedges that are tied to those options positions also are relieved or removed. And then what happens is as we move past options expiration, new positions come in. Options positions tend to really build up at those monthly expirations. That's the third Friday of every month. And then with that, there's corresponding hedges that build up. And then, of course, those positions build and build and build until that third Friday of the month. Then those positions expire. Hedges are covered. That can move the underlying stocks, and then we rebuild. So that's the typical cycle that we go through. Not every expiration is meaningful to all stocks. There's certain times, like in December, it was a very big index options expiration, so very big for the S&P 500 and like the NASDAQ. This January expiration is more about single stock expirations or single stock positions that have built up.
So yeah, as we look at the next slide, you can kind of see this. You can see, especially looking back, some of these options expirations were very, very significant for the market, and some of them weren't. And can you just talk a little bit about what the criteria you look for when we're heading into an options expiration to determine, could this be significant or not?
Yeah, absolutely. And I have a couple of slides where we can really dig in on this. And what you see here is a lot of people look at this and rightfully so say, hey, there's a lot of X's on these charts, which signify the options expirations. There's a lot of X's on these charts that don't appear to be that meaningful because there's obviously an expiration every month, but there's some very key critical expirations. We talk about this oftentimes. March of 2020, the market low was the day after options expiration. Same thing in December of 2018. June of 2022 was a huge expiration. That was a turning point. And there's these other times where expiration has marked a top as well. And that's because, again, we think that these underlying hedging flows help to push the market in a certain direction. And then as these positions expire, those underlying hedging flows are removed or roll off. Now, to your question, the critical point here is how are you measuring these hedging flows to figure out, one, how do you quantify them? And then, therefore, how do you measure the market impact? And there's a couple of different metrics. Many of you have probably heard the term gamma before. In this case, what we tend to do is we measure gamma in a notional term. So in theory, as you can see here, we're looking at the S&P 500. And the huge strike on the board right now is the 4,800 strike. And in orange, we have calls, and in blue, we have puts. And what you can see here is that from a dollar notional perspective, there's about $400 million of call gamma there. This is across all the S&P 500 index, and about, call it $250 million of put gamma there. Now, a lot of these positions may net out, meaning some calls are long and some puts are short, et cetera. But what we do is we measure this in dollar notional value. And what that is meant to signify is how much dollars of hedging flow would have to occur in this case if the market went up or down by 1%, or even sometimes a little bit of a smaller value. But this is dollars of notional value that has to get bought or sold. So in theory, how much dollar-wise of futures has to get bought or sold if the market was to move up or down, 50 or 100 basis points. So that's how we translate the position or the impact of positions into actual hedging flows. What's also interesting about Gamma is highest for at the money options. So if the index is at 4770 where it is right now, Gamma is highest for that specific strike. And then Gamma increases as we get closer to when expiration is coming. So Gamma increases as time decreases, so to speak. So it's a nice weighting mechanism for estimating how impactful options hedging flows are, right? Because if you were just to measure this in open interest terms, you could have a whole bunch of contracts that were positioned at, say, 3,000 in the S&P, and maybe there's, hundreds of millions of contracts at 3,000 in the S&P, but they're so far away, there's no hedging value associated to them. They're sitting there dormant. And the gamma of those positions would be in accordance very close to zero. So the gamma is a nice way of putting into context how large hedging flows are associated to these various strikes.
So when we think about if an expiration is going to be impactful, is a big part of it, like, will people, obviously these positions are expiring, is a lot of it, will people take the same positions again after the expiration? But I guess even if they would, to your point before, like, they're going to have lower gamma, right? Because we're a lot less close to expiration. So it still could be impactful, even if people are going to kind of take the same positions again after the expiration. I don't know if I said that right, but.
Yeah, you did. So there's obviously a bunch of different dynamics here. And if we just sort of zoom out a little bit, leave the zero DTE or the short dated people kind of aside. But let's just say you're the type of a larger fund and you have bigger positions that you just roll once a month. If you say sold the 4,800 calls for January options expiration, you're likely to roll those positions, what we'd say is up and out, meaning that I'm going to sell, rather than selling the 4,800 call for February, because we're so close to that strike, I'm going to sell the February 4,850 calls or the 4,900 calls, right? Because that's 30 days out from now. I'm going to roll that position up in value and price and out in time. So the gamma associated with the new call position would be lower, right? Because I'm selling an at the money call for an out of the money call with a longer date to expiration. So when we think about options expirations, there's oftentimes this pinning effect. And I think the pinning effect comes because you get all of these options positions that are building up. They all start to concentrate more and more and more towards the Friday expiration. Hedging flows start to concentrate in that same area, and so you get a lot of hedging flows that really pin the market down. So right now we've just been wrestling with this 4770 area in the S&P for the last week, and that's likely to be kind of the upside resistance line into Friday. And then what happens on Friday is a lot of these positions expire. We'll lose at least a third of these positions that you see on our screen here. And then suddenly the market can move more freely because all those hedging flows that are holding the market down suddenly kind of spread out or are removed. And then you start to get a breakout or breakdown in market prices.
So does it tell you anything? Like, I'm looking at this and it's a pretty balanced expiration. So does that tell you anything? We're talking about the market moving more freely. Does it tell you anything about which direction it might move? Or because it's a balanced expiration, could it really go either way? We're just allowing it to move more freely once this expiration goes through.
That's a great question. So we believe at the extremes, when you have a lot of call buying or a lot of puts buying, and the markets are really moving sharply, that these options expirations bring mean reversion after the expiration. So if I just kind of flip back to this chart here and we look at the most extreme scenario ever was March of 2020, the world was ending. We all thought the world was ending. People were buying puts hand over fist. There was a ton of volatility. And it creates this feedback loop, right? The market drives lower, so put values increase, which requires more downside hedging flows, selling futures, et cetera. Volatility spikes, which means put values increase even more, which makes more downside hedging flows. And those flows were huge into that March expiration. And then all of a sudden, when March expiration hits, all those puts are gone. And you have all of these short hedges on, short futures and short stock hedges. They don't need to that market makers and dealers don't need to be short that much anymore because all these big put positions expire. And so what happens is they then cover those short hedges, and the market starts to rally. That's the very extreme scenario. And I think you can see that in single stocks oftentimes as well, where, have everyone piling into, say, NVIDIA calls. And when those calls expire, the stock will mean revert a little bit. In these situations, what's interesting is that you often have a lot of short calls, calls being sold in the S&P 500. And so I think that the OPEX effect is not quite as obvious when things are a little bit more average. And to your earlier point, this is a very balanced expiration in that there's a fair amount of calls and there's a fair amount of puts. In other words, the blue and orange lines on your screen are pretty even. And I think that's a general time when there's not a whole lot of risk in the general price area where we're trading. Now, if we start to slide lower, you see that the relative amount of blue picks up more so than the orange, meaning put values or put gamma increases more relative to calls. And I think that's when risk can really pick up. And the same thing sometimes the upside, where if we break over 4,800 and it's calls that start to get bought, right, then maybe we have a little more risk to the upside or movement to the upside. So when we're in this balanced zone, volatility tends to be low. We tend to kind of stick into those areas. And then when we move to where there's more of an imbalance, then I think the market tends to move quite a bit more.
Because one of the things people have been talking about for a long time is that this January expiration could be a significant turning point. But if we wanted to see like very, very strong evidence that it might be, what we'd want to see is we'd want to see the orange be a lot bigger than the blue. And we'd also kind of want to see a big run up in the market into it. And we're kind of getting a balanced expiration here. And also the market's certainly not falling apart, but it's kind of just been, plodding along here. So does that make it less likely you see like a significant mean reversion off of this?
Yeah, there's a different dynamic to this particular expiration. So to be clear, what we're looking at here is just the S&P 500 itself. And there's a fair amount of balance there to your point. The S&P right now is, 1%, less than 1% from all-time highs, actually maybe just 50 bips. The NASDAQ recently was near its all-time highs. So, we've been just sort of pinned up against the top, so to speak. And actually I've been posting a little bit about this. We just mentioned this range. And as you can see here, we're just ping-ponging back and forth between this range. And this range goes back into mid-December. Here's the December expiration back here that we had done our last podcast about. And so we've just been moving back and forth, but this 4,800 is basically all-time high in the S&P. And that actually was set back in December or early January of 2022 after a very significant market rally in 2021. So, there's a lot of synergies between now and January of 2022. And the reason I bring this up is because January 2022 had a massive options expiration. And it's really the main data point that we have to compare this current environment to the last environment. One other point on this gamma, just back to the idea of the OPEX cycle. The reason that this gamma matters and the way that we project this gamma, I just want to interject on this quickly, is that we talked about the balance. And what that balance brings us is, along the x-axis is our daily gamma reading. So how much gamma is in the S&P 500? And currently we're around a 1.5. And what you can see is that with a gamma reading of 1.5, which is the x-axis, the amount of volatility, so the one-day forward movement in the S&P, tends to be very tight and very, very low, really. And you can see that on this chart. And then what happens as gamma gets more negative, or the gamma index declines, volatility tends to increase. So what's going to happen here with this expiration, just from an index perspective, is this big gamma that's creating that 1.5 reading in the S&P 500 gamma index that we have. When we expire, we're going to lose a bunch of that position, right? And this gamma index here is going to go likely down towards 1, and then volatility should increase a little bit, meaning market movement should increase a little bit. So that was a small segue into what is the more interesting part of this expiration, is that what we have today is a massive January equity options expiration. So this is not a big index expiration. It's a much bigger single stock expiration. And why is that? So in this chart before, we had these interesting orange and blue bars. Orange is calls and blue is puts. Just to make things confusing, this chart, which I just built this morning, in purple is calls and in teal is puts. So what's interesting about this chart as well is that we didn't measure it by gamma. We measured this by delta. And so why would we measure something by delta? Delta tells us the value of stock hedges on that relate to the positions that are set to expire. So what this is telling us here, and the fact that this purple bar is billions of dollars, right, in value. If you think about last year, the stock markets, general broad market indices were up 30%. I think NASDAQ was up closer to 50% last year. And so, the most famous person who does this is Nancy Pelosi. She likes to buy a lot of leaps, but there's a lot of people that, wealth managers that also buy leaps. So what you do is you buy, January of last year, you bought at the money NVIDIA calls, or at the money or slightly out of the money, whatever it may be, tech calls. And then those stocks double or triple or whatever they do. And so those call values gain tremendously, right? You have an NVIDIA call that you bought for $10. It's now worth $200. And the size of the hedges associated with those calls have to go up as well. And so what we do is we measure that by delta, because delta tells us how much the option is worth in stock equivalent, right? So, this is hundreds of billions of dollars here. Whereas what gamma is telling us is how much do those deltas have to change if the stock market moves up or down a little bit. delta is telling us, in theory, the amount of hedges, the size of the notional value of hedges that have to get removed at options expiration. Now, the other situation, so essentially on Friday, we're going to have all these calls expire. Many of them are very deep in the money. They're going to expire. And so the theory here is that we have billions of dollars worth of single stock hedges that have to get sold. So if there are all these deep in the money NVIDIA calls that dealers sold, they have long stock, they own NVIDIA stock as a hedge, they're going to have to sell that NVIDIA stock when these options expire. And when they do that, that could, in theory, start to push single stocks materially lower. Now, the other scenario, not only does that happen at expiration, if the stock market starts to meaningfully decline today, we're doing this presentation on Tuesday, January 16th, the morning of, if the stock market just started to sell off meaningfully today, then these stock hedges would start to get unwind at the same time, right? So that selling could start now. If the stock market started to really drop, and in theory, this pressure or this potential exists through, I would say, Monday of next week. So we only got another couple of days, trading days here of this potential expiration impact.
So as I set my investment strategy for 2024, is the big question, is Nancy going to buy the leaps again?
Yeah, well, to your point about rolling, it's the exact question, right? If you have a deep in the money NVIDIA call, you go, I still love NVIDIA. You're not going to buy that same deep in the money call, right? You're going to collect your money, and then you're going to buy a new at the money or slightly out of the money NVIDIA call. So NVIDIA was trading, I think 250 or 200, last year at this time. Now it's at 550. So you're going to buy a 600 strike call. You're going to sell your 200 or 250 strike call that's deep in the money, pocket a bunch of those funds and buy a 600 strike call for, a fraction of what you had invested before. You still get that upside exposure if the stock goes up, but you profited rather handsomely from that trade. So the delta value, as well as the gamma value that would exist for the next January expiration, is just going to be a fraction of what it is today.
I'm just curious, why would, for people who aren't familiar, why would someone like Nancy use leaps versus buying the underlying stock? Like, what is the return profile difference between using the leaps and buying the stock itself?
I think the risk reward, so options are leverage, number one, and the risk reward, particularly when you get very big market moves, the risk reward, obviously, of owning options versus a stock is much better. You have fixed risk when you buy a call, right? So if I spend $1,000 on an NVIDIA call, that's my max risk. But if NVIDIA goes up 100% like it did, or 200-300%, you make a ton of money there for very little leverage, right? And so that fixed risk is really what's the main benefit of it. If we have a sharp drawdown this year, look, I lost my $1,000, that's too bad. But in a year like I just had, I made many multiples on that because of the fact that NVIDIA went up so much. Nancy Pelosi's calls, I don't know if she had NVIDIA calls this last round, but she'd be up thousands of percent on that return. So that's the main reason that fixed risk, and that that's guaranteed equity upside in your portfolio if the stocks you choose go up, and if you choose the Mag 7 names, those have performed very well. So that's really what the benefit is there, is that fixed risk and that leverage that you get to the upside, levered upside.
Yeah, you can't really argue with her track record. I mean, I think most hedge funds have been underperforming Nancy in the last few years, so it seems to have worked out for her.
Yeah, congressional traders, I guess, in general do do pretty well, but yeah, you in a year like last year or 2021, you just kill it. And to be honest with you, in 2023, yeah, her calls lost money probably if she had them. I don't know what she had, but most people suffered pretty brutally last year, right, in the equity drawdown. If you own $100,000 worth of NVIDIA stock and it goes down 50%, well, that hurts, right? Whereas if you own the calls, it doesn't hurt anywhere near as much.
So going back to the idea that there's a lot of single stocks expiring here, I mean, how do you see sort of the balance between like the risk to the market? And we've talked about this idea of dispersion before, like the idea that like the market's not going anywhere, but you got all kinds of movement underneath. I mean, is that the type of thing you see here? Is like, maybe there's some risk to these large tech stocks, but and they are a huge percentage of the market. So I guess that is a risk to the market overall, but how do you see that playing out?
Yeah, we compile a little bit later in the presentation here a list of stocks that have the biggest expiration, but like Meta is one of the bigger names, Google, Netflix, et cetera. And when those stocks, if they do start to go down because of correlation, there's such big components of the S&P 500, they're going to drag the equity index lower. The equity index, correlation hasn't been that strong recently, meaning, if you look at rallies of the last year, the Mag 7s have outperformed so much. And if you look at volatility and the way that volatility has been reacting, the S&P doesn't react, one could argue, the same way in volatility terms as it used to, I think, meaning that the underlying components seem to move a lot more independently from the index itself in various ways. But obviously, if the Mag 7s go down 10% tomorrow, the S&P is going to go down, right? And maybe it doesn't go down 10% because it's a little more diversified. And maybe NASDAQ has more of a sell-off. But the point is those underlying constituents go down, that should bring the market down or the broader indices down with it.
Yeah, and as you mentioned, we'll get into that a little bit more in a second here when we get to our What's Moving segment. But first, we want to go to our What's Moved segment. So we always want to hold ourselves accountable to some degree and talk about what we talked about in the last episode and see how things played out relative to what we talked about. So can you sort of talk about what we talked about in December and how things played out relative to that?
Yeah, absolutely. And I like this because it's caused me to be, a little more introspective and just looking back and saying, hey, how do we do? What did happen? What didn't? So from the December OPEX review, we looked at the heavy call volume in the IWMs, and there was a real call skew there. What a call skew was telling us is that call implied volatility, or the implied volatility value for out of the money calls, was increasing. And when that happens, that tells us that there's a lot of long call demand. So people are buying calls in the IWM, trying to chase, right? That was a big theme. Would the IWMs play catch up? And turns out IWMs did very well from December OPEX into this current period. Second one, we talked a lot about this December 2021 analogy, and we made mention of the big January options expiration. This analogy has been very strangely working out. We're going to talk about this in depth. It's really fascinating to me. And then the last one is we thought that the massive December expiration would trigger more volatility. Equity markets broke higher after. Hard to say that, Brent, you guys really nailed this one. So I'll just take an L on that third one. And we'll talk about that. So first, IWMs. Here's the December options expiration right before the Powell pivot, I call it now. I know that there was another Powell pivot, I think back in December of 2018. But he pivoted and said, hey, we're thinking we're going to cut rates, which I think the market was surprised by. And there was a big gap up there, obviously, right, in the S&P and broad equities in general, but particularly IWM. So you can see on our chart here from more or less where we talked about the small cap rally, they went up about 10% after that. They're still up a good 4% from when we discussed it in our video. And they've been solidly outperforming the S&P up to yesterday. Second, OPEX volatility, very hard to say that anything happened materially after OPEX. You can see here that we pinned the week of OPEX. You can make that maybe argument, the black line here being options expiration. And we moved up about 1% to 2% into the end of the year. And we're still really in that same zone.
One of the things I've learned a lot from you guys who work in options is this idea of, although we talked about increased volatility, this idea of thinking in probabilities is so important to everybody who operates in the options world. Anything you talk about with options and anything you talk about in the market in general, there's always a percentage on one side and always a percentage on the other side. And a lot of people tend to have these really strong calls and say, this is 100% going to happen. And I'm 100% confident about this. And I think that's something you really learn from options because of the way the payouts and stuff work is there's always this probability distribution behind the scenes. Yes. And you always look at there's always one side and there's always the other side. You're trying to put the probabilities in your favor while understanding that there is always the probability in the other side as well.
Yeah, you're 100% right. And I think that's the biggest trap for traders that are new to the options market is the idea of negatively versus positively skewed payouts, meaning that people love these trades like selling zero DTE or short dated options, the S&P, for example. They'll say, hey, I'm right 8 out of 10 times, and that means that how could I possibly lose money at this? I'm going to be filthy rich because I'm right 8 out of 10 times. Problem is, on the 8 times you're right, you make, I don't know, a dime or a nickel or 25 cents, right? But when you're wrong, you lose $5. And that's the idea of the payout being skewed incorrectly. It's very hard to do the opposite of saying, I'm going to lose 8 out of 10 times, but the time I'm right, I'm going to make, like Nancy Pelosi on her NVIDIA trade or whatever, I'm going to make, 10x what I lost, or 20x or 30x what I lost on those other, 8 attempts. And then that is a very profitable strategy, right? People have a very hard time, I think, getting comfortable with that because it doesn't feel good to lose 8 out of 10 times. But if you make, a whole bunch on the time you're right, then those strategies can pay off handsomely. And
Yeah,
that's
when
what
you were
options is about is probability and playing the distributions.
yeah, when you were talking about that, I was thinking about XIV, because XIV you won a huge percentage of the
Yeah.
time, and then when you lost everything. So,
100%. Yeah.
unfortunately, things like that seem like they're obvious trades, but no matter what the return is, when you're right, when you're wrong, you lose everything, then, the trade's eventually going to blow up. It's just the nature of it.
Yeah, you're 100% right. And the better the trades do, kind of like zero DT, the better the trades do, the more people pile on. I mean, you and I have been in this business for a long time, and we know that if there is edge, it only exists for a small amount of time, and it gets exploited pretty quickly. I think those of us who are more retail traders, like myself, there are these smaller edges that bigger funds can't take advantage of. Maybe they don't bother playing if they can't make enough that it's not meaningful to their assets, right? And so there's some strategies and ideas that can persist a little bit longer, but any kind of a large edge like that's going to be extracted if it's a real edge.
So the next slide, you're talking about this December 21 analogy, and I think it's sort of playing out the way you thought it would. So can you just talk about like now relative to December 21 and what you're seeing?
Yeah, I've been fascinated by this analogy, and what, to set the stage in December of 2021, there was a massive stock market rally in 2021, and they started to threaten raising rates, and I think people started to come around to that idea in late November, 2021, early December. But the market kind of just said, let's just finish this off at all-time highs. And so you can see here on January 3rd of 2022, we hit the all-time high in the S&P. I think it was 4803. And then what happened was we had two big sell-offs. There was one initial round of sell-offs that dropped the S&P 2-3%. And then this exact week, which is the week leading to options expiration, the S&P dropped about 5.6%. And it made its low on the Monday after options expiration. The VIX made its intraday high on that same day. And then that led right into FOMC. So that intraday high of the VIX, I think, was 38. We didn't make a new high the rest of the whole year, even though the S&P, as you can see on our screen, went materially lower. We had the whole, Russian-Ukraine conflict sparked off. It's just a very bad year. But the VIX high, again, was made in that January timeframe. So we are right in this window of this weakness that occurred in January of 2022. And again, this was the reason the OPEX was so important back then, was that there were these huge deep in the money calls that were expiring because the market rallied so much in 2021. We have bigger relative call positions now. That delta value that I mentioned in that slide earlier, it's larger now than it was in January of 2022. So we're sitting here in roughly the same time frame at roughly the same price, with the same forces arguably right here. Now, obviously, the big difference is Powell's about to kick off a whole bunch of rate increases. He's saying he's going to decrease rates right now, but it's, there's just a lot of just synergies here. And again, you can see that kind of 8% decline from the start of January roughly to this January OPEX. FOMC this time is on the February 1st, I believe, so about 2 weeks out. The other interesting thing is at the start of February is when the Russian invasion kicked off. And, there's this stuff going on with Iran and in the Red Sea. And I'm not a geopolitical expert. I'm not even going to pretend for a moment. It's just that things seem to be escalating there, right? Which is just this weird synergy to the time frame of, what happened out of FOMC into February. The geopolitical risk, I think all of us would agree, it's real that another kind of conflict could kick off here. And that time's right with this February timeframe. I don't know if that's, related to, I don't want to make light of stuff, but, moon cycles or some other kind of bizarre stuff. But there's just, again, a lot of just synergies here. And then not only that, we have not been able to break 4,800, even though we tried twice. 4,700 was the initial low we put into January, which was very close to the initial low, that first drawdown in January of 2022. So, I think this is a risky week for the market. And 4,700 is this level to watch. If we break that 4,700 level, then I think the speed of the decline could really accelerate based on all these different options positions.
And as you pointed out, we've got a CPI report in January, and we had a hot one in the same analogy there was a hot one that sort of, I think, got the market going down a little bit.
Yeah. I mean, the initial reaction to the CPI that just came out, was, oh, this is a little hot, right? And then, I think some Fed speakers came out and jawboned it a little lower, whatever it may be. It was very interesting that if you look back in January of 2022, after the CPI, it said that, look, stocks closed lower. So this past Friday would have been the day that the market really reacted to that because of this hot CPI. I think we got a hot CPI, this past week. Market started to pull down, and then we kind of reflexively just pop back higher, which is kind of a funny thing. But it's just this very interesting thing that CPI was also hot back then. Again, it's a different macro rate environment in terms of the direction I think we're trying to go in with the Fed. But it's just another sort of synergy that I noted.
So as we move from what's moving to from what moved to what's moving, you've got some new ideas here for this month.
Yeah, we covered a little bit on it. We touched on some of these ideas, but what I really want to talk on is two different concepts. We talked a lot about these in our subscriber notes this morning. Number one is volatility just in general. So on your screen here is realized or historical volatility for the S&P 500. So a measure or rolling windows of how much has the market been moving. And if you look, the most of us in the options land pay initial attention at least to 1 month implied realized volatility. 1 month is in green on this chart. It's currently at 10.6. We hit lows in realized 1 month realized volatility towards the end of last year when we got down to the 6 to 8 level. And these readings just in general are as low as it gets in the S&P 500. As you can see, back in 2021, we hit a similar period of realized low volatility, but you'd have to go back to 2017 to get a sustained level of lower realized volatility. So that tells us that the market is really not moving a lot. Probably not a giant revelation to anyone listening here. It's been a pretty risk-free market over the last couple of months here, and that's being reflected in this data. Now, what's important about this is that realized volatility is the basis for what the VIX or other views of implied volatility or forward volatility should be. And so when we look at this and you say, hey, Brent, what should the VIX be at? What's a fair value? Well, if you take this 10, right, 1 month realized of 10, and you add 3 points to it, that's this historical average, then you would say, okay, VIX 13 is about fair value. And that's a very finger in the air assumption. A lot of you who are options aficionados will scoff a little bit, but if you just look at the long-term average, that's what it is. And so you can see here the VIX currently is 13-ish. If you look at it on the screens today, 13 and a half. And those levels, this 12 to 13 area is the lowest level of the VIX going back to pre-COVID. So these are, 3-year lows in the VIX. What that tells us that traders are seeing lower risk now in the market, pricing in lower risk now than they have in 3 years. If you look at what we call term structure in the S&P, today, this morning, volatility is up a little bit. As we talk here, and these shots are from Monday or Sunday night when the market was closed. You can see this cone represents the 10th to 90th percentile value of the term structure, S&P term structure, over the last 60 days. So term structure measures at the money implied volatility for every expiration out in time. So we're right kind of smack in the middle of this cone, but this cone occurs over a time of pretty calm periods of the market, right? So another way to look at this is to say, hey, if at the money implied volatility for most expirations here going out in time is roughly 10, 11%, that tells us the market's pricing in, 60, 70 basis point daily moves in the S&P 500. Those are pretty tight ranges, right? That's not a lot of movement in the S&P. The one day that's a little bit elevated here is FOMC for that February 2nd or 1st time frame. Pardon me, I forget exactly what date it is. But there's the point here is there's very low risk being priced into the market. Despite that hot CPI, despite maybe some geopolitical tensions, despite maybe this big options expiration, it's kind of a honey badger market. It just doesn't care at the moment.
People talk a lot about these products that are out there that sort of sell volatility or short volatility and like the rise of them. Is that contributing to the fact that we have low realized volatility right now?
Yeah. If you look, and Nomura puts this out a lot, they show you what the Sharpe ratio is of just selling S&P puts. And it's fantastic. I think it's like a Sharpe ratio of 4 or something. It's crazy because it just works all the time. Kind of like the XIV trade you mentioned before, because the market tends to go up. If the market pulls back a little bit and volatility starts to go up, it gets slammed and market pops back up. And selling puts is it's in vogue right now. Selling volatility is in vogue because when it works great because not only do you not need the market, if the market goes up, it profits. If volatility just comes down, it profits. You don't even need the market to necessarily go your way. But the problem is when you're wrong, back to those positively and negative skewed payouts, if you're short puts and the market goes down, it hurts. And naturally what happens is, to the other point is, these trades are feedback loop trades, meaning selling puts works really well. And the better it works, the more puts get sold, the more volatility gets sold, right? And then all of a sudden volatility gets squeezed into this box where the risk return isn't very good, doesn't stop people from doing it. And then you get a little bit of shake, right? The market moves just a little bit. And then suddenly everyone has to puke out of these short put positions or short volatility positions. That's what XIV was back in 2019, right? That happened off this very calm period in markets. I would argue that there's not a whole lot of volatility downside left here in the market, right? If you're starting to price in daily moves, the S&P of 60 basis points, it doesn't take a lot to shake the market to make it move more than that, right? So if you have a 1% down day, then suddenly everyone who's short volatility betting on 50 or 60 basis points of movement, they're all off sides, right? And they have to cover, and that creates more long volatility trading as people have to cover, and that can make markets move more. So, it's a feedback loop that has to unwind and suddenly start to feedback in the other direction.
Yeah, those trades have always struck me, and there's like a lot of trades like this in investing where you sort of know what the eventual outcome will be,
yes,
but you don't know the timing. And so there's not much you can do about it. Like, so people will always say, oh, this short volatility trade has to blow up. And then it'll go on for 2 years or something. And then eventually it'll blow up. But unfortunately, they've lost so much money, trying to figure out when it's going to happen that it's like very hard to get the timing right on those types of things.
You couldn't be more right. It's literally a game of musical chairs, and you don't know when the music will stop. It could, to your point, it could last like in 2017, you go, this is ridiculous. And it just kept on going. The vol kept on going. That realized vol metric, I think, hit 3.9% that we talked about before. That's the all-time low, I believe, was in August of 2018 or 17, excuse me. And then, Volmageddon was 2018. So, these are very good trades when volatility spikes up a little bit and the premium you're getting for taking this risk is, a little better. It's more comfortable to do that when the risk is a little bit higher, but you get paid more for it. And then at some point you just extract that value, and when the value gets extracted, it's hard to sit there and say, I can't really milk this cow anymore, right? Like the value's been extracted. And if the trade keeps going for 6 more months, well, I would have missed a lot, right? And you will. But the problem is, again, one wrong move causes, just a world of hurt. And so, the question is, hey, are we at this world of possible hurt where there could be this, downside jump? And I'm not making a market top for 2024 call. I'm just simply saying we could have a sharp 3-4% decline this week simply off these OPEX dynamics, coupled with the fact that volatility is low here. Implied volatility is pretty low. And so if vol does start to respond, that speeds up the downside, right? And that's where you can get this kind of extended downside reaction into options expiration because vol is pretty low right here. And people tend to be maybe short puts rather than long puts.
So in this next slide, you're looking at the February OPEX, looking a little bit forward. What are you seeing in this?
This cone here that you see is the 90th to 10th percentile of February OPEX skew. So basically, what does skew implied volatility look like for a 30, let's call it roughly 30 days to expiration option, which is what the February monthly expiration is. And what you can see is that the February vols are at the bottom of this cone, which tells us that these are, the lowest implied vols that we've seen over the last 60 days. Again, this has been a pretty low risk 60 days. So these vols are low relative to history, recent history. Now, low volatility, the famous saying is, doesn't mean cheap volatility, and that's true. But if you are full up in equity portfolio right now, you're fully exposed and you're happy with those gains, you could make the argument that it's pretty cheap right now to hedge out these puts, hedge out buying 5 to 10% of the money puts. And this also includes FOMC. So I don't know if FOMC is going to come through and Powell's just going to reiterate his short, hey, we're cutting rates. People are pricing in a ton of rate cuts right now. It's a real kind of Goldilocks period for markets. And so if that gets upset at all, these puts could pay out pretty well based on the fact that relative to recent history, these implied vols are pretty low. And this recent period, again, has been a pretty low risk period just in general. So you could argue, and I think I'd make the arguments that downside hedging is pretty cheap. Doesn't mean it pays off, but it doesn't cost you much to hedge out some exposure.
Yeah, and in this next slide, you're also getting into this idea of low IV.
Right. So this is what we call our fixed strike dashboard. We at SPOTGAMMA have just launched a new implied volatility dashboard. So these last charts I want to plug are part of that new implied volatility dashboard. And what you see here is a general sea of red. So strikes are across the x-axis. All the expirations available are across the y-axis. And what you're seeing in this sea of red is the fact that implied volatility values are at extreme lows here. And we measure them in this z-score metric. And so you see the sea of red. This is telling you that even though the market is, market's been pinned to this range, not only are people not really betting on downside, if you saw downside bets, you'd see a shade of green, right, as opposed to just red. There's also not a bid to upside. So 4,800 we mentioned as this kind of call wall resistance area. There's not people sitting here saying, hey, I'm not betting the market's going down, so I'm going to bet on big upside. People are sitting on their hands to the upside as well, which is a key note here, right? And we have another slide here on NVIDIA and some of these other Mag 7s that show you that people are really sitting on their hands at this moment. I think waiting on Powell to confirm these rate cuts, or just maybe they're waiting on earnings, which is just picked up to say, okay, look, our PE estimates are too low right now, so let's jack them up and we have some more upside in stock. It's a very neutral zone at this moment. And there's this trigger of OPEX selling flows. People may just be forced to go with that because they don't have an opinion, writ large. In the market in general.
Just briefly for people who aren't familiar, can you talk about the idea of fixed strike vol versus the VIX? Because the VIX is what people are seeing out, in the market every day. Like, what's the difference and why is fixed strike vol important?
That's a great question. So what fixed strike vol is simply showing you, and if you had our dashboard, if you hovered over any one of these cells, it would tell you what the implied volatility is for a given strike at a given expiration. And there's a lot of value in monitoring what the strike what the implied volatility is for a given strike, because that is telling you, and some would argue in a little more of a clean way, how volatility is reacting. Particularly if the S&P is revisiting a certain price, like revisiting 4,800 to the upside or revisiting 4,750 to the downside, right? If that fixed strike volatility 4,750 to the downside or 4,800, if that starts to go up, then you'll know that the demand, you could argue, the demand at that strike is increasing. The problem is when you use something that is like an indexified or an index measurement of volatility like the VIX, it is changing what its input parameter is. What I mean by that is the VIX measures or gives a higher weighting to the money options, and it always uses options that expire 30 days out in time. So the at the money implied volatility is simply wherever the S&P is trading at this moment. So what does that mean? That means that right now the S&P is at 47.75. So the VIX is using 47.75 options 30 days out in time as the bulk of its calculation. If the market goes up, if the S&P goes up to 48.25, then the VIX will be using or overweighting that 48.25. Well, as we all know, there's a natural skew in volatility pricing for strikes in the S&P, meaning that the 100% or 110, right, implied volatility in S&P is lower. In other words, call implied vols or out of the money calls tend to trade at a lower implied vol than out of the money puts. There's that kind of smirk that we're all aware of. So when the VIX goes up, it's using naturally lower implied volatility values as simply as a function of that's the way that implied vol is skewed in the S&P. So what you could see is that if we take the other side, the S&P goes down 50 basis points, the VIX is naturally going to go up because these fixed strike vols are higher at these lower strikes. So it's not that the VIX went up because people are demanding. It's simply that the VIX is using these puts that have a higher implied vol calculation in them. If there was actual fear in the market and the VIX and the market went down 50 basis points and you saw fixed strike vol itself increase, meaning 47.50 implied volatility, that specific strike for, say, February expiration, if that value itself went from, say, 20 to 30, then you know there was true demand for downside protection because that volatility went up on a fixed strike basis.
So it's a cleaner measure, basically.
It's a cleaner measure of risk, absolutely. It's a little bit more specific and it takes a little bit more analysis, meaning that when I wake up in the morning, I just look at the VIX because I go, is the VIX up or down today? Just as a finger in the air measurement of risk. But if I really want to see if there's actual demand for downside protection, I want to look at it on a fixed strike vol basis because that's telling me exactly what buyers and sellers are doing. It's not simply a function of the calculation.
So in the next slide, we're getting to what we talked about earlier here, which is the Mag 7 and NVIDIA.
Yeah. So, the theme that we just covered here is that there's no bid to volatility really. It's very low. And that in and of itself is a risk. Doesn't mean the risk has to, that it itself is a trigger of risk. It's a concern that if the market starts to move down and volatility catches a bid, it's got a long way to go, and that could speed up downside. So that's that embedded risk. And 4,700, if that breaks in the S&P, certainly doesn't appear it's going to break, at least today. That is the embedded risk. The second thing is this idea that, where's the upside right now? There was a 5% move down in the Mag 7s writ large. This is the MGK index. It's a growth ETF from Vanguard that has an overweight measurement here of the Mag 7s. It was down 4 to 5% to start the year. But then immediately last week, all of these names, the Mag 7s, ripped higher. Like NVIDIA was up massively, right? And we stalled right back at like this double top level, essentially in this Mag 7 index. So it's fascinating to me that you get this mean reversion, this violent mean reversion, but the move totally stalled out at the double top. So when I see things like that, I often think that these are hedging flows, because if you think of the end of the year as fair value, right? And you pull these down and it creates this move down, there are these hedging flows will then buy that stuff back up, right? And that hedging flow would in theory exhaust as we hit basically back to the point we were before, right? You get this forced mean reversion trade, and then the fuel dries out. If you had a speculative long position, why would the speculative longs all just sort of stop at this double top area? Like, why would these flows suddenly get exhausted so quickly? If NVIDIA launched these new chips that were the best thing ever, then why do we sort of stop? So the move higher just abruptly stops, right? The trend just stops. So to dig into this kind of concept, if you look at NVIDIA, I think it was up 10% last week. There's this massive amount of game at the 550 strike, which I haven't checked the stock this morning, but that's where we really stalled out last week. This is obviously this pinning point for NVIDIA. I think into this week, they have earnings that's coming up pretty soon, as well as some of these other top names. I think people need another reason to bid, these things up into new highs. Powell and earnings may be that driver. I don't know, but the fact is that the market is pricing in now really low volatility. This is NVIDIA's volatility cone that we just showed for the market in general. I think this is 1 month volatility for S&P, for NVIDIA. And you can see the skew here is at the bottom of its level for the last 60 days, which has been a very volatile 60 days in the stock. So there's not a lot of expectation of movement right now. Things are very much in a neutral zone kind of across the board. And it seems like this next month is really going to set up a pretty big directional trend from, call it January 1st, 2nd into January options expiration. From my perspective, people are not betting on downside, but again, the point here is that they're also not betting on upside, right? We're literally just sort of floating in kind of thin air. And so I think that, we're really looking for another moment of volatility here. And that volatility means pretty sharp movement to the upside or downside. And again, that it's a very sort of unbiased opinion, but the fact that people are pricing in no movement right now, and Powell's going to kind of, I think, in these earnings are really going to tip the scale. I think we're setting up for a lot more relative volatility here into that early February timeframe.
Yeah, and in this next slide, you're looking at some names with large expirations, and I'm seeing a lot of the names I recognize: the Metas, the Netflix, the Amazons, Google. It seems like what you talked about is true here. Like a lot of big expirations in these big names.
Yeah, and so we created this OPEX impact scale, and what we did is we essentially looked at how big that deltas are that are set to expire versus stock volume, just to get an idea of how big the impact could be. And so I flagged 3 names somewhat randomly here: Meta, Royal Caribbean Cruise Lines, and PANW. Just to give a broader subset of stocks, right? I didn't want to choose just the Mag 7s. And the idea is here is like, well, what do these things look like as they head in this big expiration? The idea being that if these names start to sell off here, that at some point these OPEX hedging flows could pick up and start to impact to the downside. Now, it's important to note that I don't see that OPEX create any kind of a lift anymore, because these calls that are set to expire are arguably fully hedged out. meaning that if the market starts to go up or these stocks start to go up, well, since they're already fully hedged with long stock, those long stock hedges don't need to be added to hedge out upside risk. That's because these are what's called one delta options, right? They're deep in the money. However, if they start to move down enough, these stocks start to move down much, then you could be too long on your hedge and have to sell some of those long stock hedges, and that's where the impact could come. So if you look at how these stocks have done over the last year, they're all up amazingly. Royal Caribbean, the worst performer of them all, it's up 100%. Meta's up 180%. Penn W up 140% over the last year. So you can get the feeling now that, look, if you bought even slightly out of the money calls or deep out of the money calls, really, late last year at this time, those are all have performed extremely well, right? So now you can really see, okay, hey, I bought 10% of the money calls in these stocks. Well, those are now significantly in the money, and that gives you a really good visual as to why there's so much options value built up there, right? So I pulled just Meta for an example. In our systems, we measure different metrics, right? One of those is what we call our key delta strike. And what that tells you is the strike that has the biggest delta, right? So where's the biggest stock value, essentially? Which option has the biggest option position relative to stock value? And that's the 300 strike in Meta, telling us that there's a lot of people who likely bought 300 strike calls in Meta. Those are now 20 or 30% in the money. And so we can use that as this area where we know these big positions are. Now, I don't want to infer that Meta's about to drop 10 to 20%, over the next week. But the fact is that sort of puts a number on how deep these calls are. And the fact that if we do start to generate some selling here, that selling pressure in theory could really exist in theory into the date of expiration itself. And you can see the top delta expiration here for Meta here on the right. So, this is a technical component of the trade that if we start to sell, it's not like we hit 370, 370 and that pressure was relieved, that selling pressure was relieved. That selling pressure in theory could last, for a good 10% down in the stock.
So this tells us the floor is not that close, right? That's
Correct.
The idea is the floor is not tight to where Meta is right now.
That's exactly right. If this kind of feedback loop happens, there could be times where I say, hey, look, the floor is at like 370. And the stock's trading at 375. So, this risk just doesn't exist. And I, I've been talking about this for a while, and, if it happens, I'll look like a hero. If it doesn't, I'm going to look like, a little bit foolish here. But the fact is that I don't often see these kinds of setups. Doesn't mean that the setup takes place. Doesn't mean that I see this every single month. I mean, I know December was a huge options expiration, but these are the types of risks as an options analyst you have to flag and say, look, this is a material risk that we see here now. And if the market starts to sell off from this point, you'll have an idea of what is going on, right? It's these OPEX dynamics. The news cycles on CNBC and stuff, they wouldn't pick this up. They would probably flag some other kind of innocuous, headline as to why the markets are going down. And if it's OPEX that's driving the markets down, then maybe you have more confidence buying into that weakness, right? And so that's why we have to flag it. And again, there are plenty of times where we don't see this kind of formation, this kind of setup. But it exists, right here, right now, and that's why we're spending so much time on it.
So as we close out here, we're going to get into one of my favorite topics, which is zero DTE, because I know very little about it, and I've learned a lot doing this podcast with you about it. And as we start out, we've been talking on all the episodes about the idea that zero DTE is very high right now. It's like at all-time highs, and it seems like you're echoing this with the first slide.
Yeah, and people are. It's been interesting because people are tired of talking about zero DTE. In some respects, right? I think that the options traders focus on this all the time, and I've heard some industry pundits talk, and they've actually started to laugh about all the focus on zero DTE and say, hey, the risks are overblown and stuff. And I disagree with that. I don't think risks are overblown. I think the impact of this is real. It's not something that we need to be crying about every day, but you need to be aware of it. And as they sort of make light of the size of zero DTE trading, we see that zero DTEs have hit a record. And so this is data from the OCC, which is the Options Clearing Corp. They tell us once a week whether people bought or sold contracts. So they're telling us whether these were bought or sold. This is not SPOTGAMMA's kind of analysis or interpretation. What we see here is that last week we hit the most call buying in the index flow that we've ever seen. Now, they don't break it down further than simply index, but S&P is the biggest of the index volumes. So we can interpret this as saying there was record contracts bought to open in the S&P. Now, there was a spike in puts as well, but clearly the call side is much heavier. Most call buying contracts ever bought. Same thing didn't happen on the premium side. Now, if you think about 0DTE, because they expired today, they have lower premium values, meaning it costs less to buy a 0DTE contract than a 6-month out option contract. So the fact is that we have record call buying in contracts, but not premiums, tells us that 0DTE is showing us there's record buying, and it's likely record buying in 0DTE calls as a result. So that's significant. Second one is, if we look at it on a volume basis, the highest ever for the S&P index options, 56% of volume on 12/22, so just a couple weeks ago, that was the record. We hit 55% on Thursday of last week. It hit 53% on Friday of last week. Every day over the last 5 days was above 49.7%. So let's just call it 50% or higher. As you can see on this chart, we're at this sustained level and we're setting records, telling us that the percentage of volume is increasing, right? On a relative basis. If we were to make a moving average of this, we'd be kind of at the highs. And so you say, great, what is the impact of this, Brent? This is our hero system, which measures the deltas being traded in real time of the S&P 500. Now, in this case, we're looking at the S&P 500 flow. So this is SPX, SPY, and ESE mini futures. So every single time a trade takes place, we estimate how much hedging flow or the dollar value of hedging that's associated with that. On Monday, this past Monday, the 8th, we hit our largest ever, most positive hero value ever. So that's $12 billion of dollar delta notional. This was the day that the S&P rallied from 4,700 ripped up to 4760 where we're trading right now, right? This giant amount of flow. And there was no follow through on that. But 70, meaning that, Tuesday we didn't continue to rally, right? And why is that? Well, 72% of that 12 billion was 0DTE contracts being traded. As you can see, this teal line goes from bottom left to upper right. That's just 0DTE flow. So the fact that this is going up the whole time tells us people just bought calls in 0DTE and or sold puts all day long, and that helped to really lift the market. The purple line measures the flow from all options of all expirations for the S&P. That obviously was a little bit higher than the total, but this is the type of thing that we see on a daily basis. Like after CPI last Thursday, the market started to get really weak. VIX spiked, and then right at noon, these 0DT flows come in and they start to lift the market back up. So we see this on a daily basis. These, particularly right now, it seems to be skewed to call buying. So every time that the market comes down a little bit, you see these 0DT contracts come in and the markets get bid back up. I understand that people say, hey, 0DT contracts could be hedged out with other 0DT contracts. And I think on an average, daily basis or on normal trading flows that can work. But I could, outline several ways in which, that thesis breaks down, that you can just hedge 0DT with just other 0DT contracts, meaning you don't need to trade any underlying stock or shares. I think that, that can break down a lot, meaning that there are plenty of examples of how 0DT could feed into the actual underlying trading of the market.
Just a couple questions on that. One is, I don't know a ton about this. I mean, I know there's a ton of flows going on in the market on a daily basis. Some of them have to do with macro things. Some of them have to do with options. Like, without giving away your secrets here, can you just talk about how, I'm curious, like how you figure out like what is 0DTE flows at any given point? It would seem like a pretty complicated thing to come up with.
Yes. So the way that we look at this is we look at every single trade that takes place in real time, and we say, look, does this option expire today? If it does, then it's a 0DT contract for the S&P. If it expires on Friday, which is the next available expiration for like Tesla or a single stock, then we consider that a 0DT or next expiration for single stock. But let's just talk about the S&P. If it expires today, that's a 0DT contract. And then the right axis here is dollar delta notional. So in theory, delta, when you look at the delta of a contract that's traded, it's telling you the dollar value of what you need to hedge out, the contract that just traded. So, if you buy a one lot spider contract that is a 50 delta, okay, I need $50, right, to hedge out that contract. That's the rough idea here. Now, we put some proprietary kind of secret sauce on top of that, but that's just the general idea of what's happening. So when you see here that there's $8.7 billion worth of deltas over the day, that to us tells us that there's essentially $8 billion maximum of equivalent value of 0DTE contracts bought in, meaning that if you wanted the same rough exposure of the contracts that were bought today, you could buy $8 billion worth of stock. Now that's the max, extreme measurement there, right? But the days that this is higher, right, or lower, we see more impact, meaning that 8 billion is a huge value. It's our largest ever. Today or yesterday, we may only see $2 billion of 0DT deltas come in, or the hero value may only be $2 billion. That's telling us that, the equivalent of $2 billion worth of stock was just bought or sold, right? And as these metrics go up and down. And we see oftentimes that the signal front runs what the market movement is, meaning we'll see a bunch of 0DT contracts come in, and then the market will catch a bid after, right? So, there's all this evidence that suggests that this is a leading indicator. And I also believe that it is bringing mean reversion into the stock market, meaning that when the market starts to sell off, you see 0DT call buyers come in, and then the market rallies back up. And it seems to be, I think, suppressing volatility in these different, accordingly, meaning that if the market goes down and 0DT comes in and pushes the market back up, then when you look at the close to close change on the day, it was pretty small. So volatility through that lens actually is not that high because of the 0DT contracts coming in.
So when we think, as we close out here, if we think about the risk of this, you seem to have two different camps. You seem to have some people who say 0DT is not a big deal at all. You have other people who say some massive crash is coming. Like we've talked about this in previous episodes, but I think your idea was more, there could be an issue with this, but it would be more, focused on the short term on that day because these things are expiring. I mean, is that right?
Yeah, the risk I see is a flash crash. Now, flash crash, most people would say that means the market goes down. We could crash up just as easily as we could crash down, because there's arguably, like I just showed, there's a huge amount of 0DT call buyers. So, and there's not really the volatility halts and things like that when the market goes up in a crazy amount, right? But the risk here is that, everybody piles into long calls or long puts, right? Those long contracts. And that really starts to move the market a lot. And yes, of course, all of these contracts expire at the end of the day. And so we likely see that major move called a 5% intraday move or something like that, mean revert, in the next day or something like that. But that is what the embedded risk is. And the systemic risk would be if a market maker, is on the other side of that move. We had something happen like this. You remember Knight Capital blew up, right? And that didn't cause a huge market movement, but liquidity now is so concentrated in the options market and a handful of a couple of large firms that, they do a tremendous job, of providing liquidity. And I don't think anybody has a certain amount of risk, but it's not like that crazy of an idea to think, hey, everybody just piled into 0DT calls and one firm was on the wrong side of that. And, now they're having all these problems. And, that's what blew up Knight Capital back in the day. You had the flash crash with the big futures buying. What was it, 2009?
Yeah, I don't know.
I forget the date. I think the Knight blew up, I think, in 2014. If you look at what the market did over that period, it didn't, there wasn't that much overall macro movement to the market, right? So, XIV, it blew up, it broke the market for, a couple of days, right? And it caused a little bit of a drawdown, but we eventually recovered from that pretty quickly. So, those are the scenarios. And so you say, look, is this going to bring the market down to its knees? No, but I feel very strongly there's going to be this point where the market moves a lot and catches people totally off guard. And you can point at these contracts that just traded on the day as the culprit. And I think it's a totally reasonable scenario. So, those are the risks I see. Again, they're on an average given day, it's not the risk, but anytime you have this much volume concentrated on these 0DTE short dated flows, there is that tail risk of a larger market move in kind.
Yeah, that's probably a good thing to wrap up on. We got a lot of stuff into an hour here.
Yeah.
So
a lot of talking. So
for anyone who's still with us, if you want to follow the podcast, it's available on all the major audio platforms. It's available on the Excess Returns channel on YouTube. So please follow, subscribe, do all that stuff. Thank you for joining us, and we'll see you next time.
Awesome. Thanks so much, Jack.
This is Justin again. Thanks so much for tuning into this episode. If you found this discussion interesting and valuable, please subscribe in either iTunes or on YouTube, or leave a review or a comment. We appreciate it.
The opinions expressed in this podcast do not necessarily reflect the opinions of Alydia Capital. No information on this podcast should be construed as investment advice. Securities discussed in the podcast may be holdings of clients of Alydia Capital.